So, so we're going to do these ones. 3, 4, 4, 4, 5, and 4, 6. Page
192. 192.
192, thank you. Okay, so these are all little short ones here to kind of get our head wrapped around what we saw. All right, so the first one, D44 says, Leahy Advertising Corporation's trial balance at December 31 shows supplies $8,800 and supplies expense 0. On December 31, there are $1,100 of supplies on hand. That's the one. Prepare the adjusted entry December 31 and using T accounts, enter the balances in the accounts, post the adjusting entry, and indicate the adjusted balance in each account. So, when you have a supplies one, what's the magic number? What are we looking for? What we've used. When we have a supply, we're looking for what we've used. So the first thing you're going to do is a little bit of math, right? Because did they tell us what we used?
No.
No. They told us that we started with 8,800, right? And what we have left at the end, right? Was what? 1,100? So this is what we started with. This is what we ended with. So what you started with minus what you ended with is what you've used. $7,700. So we've used up $7,700. So we want to do an adjusting entry to recognize that we've used that up and that is now an expense. So the rule for the expense adjusting entry is we debit an expense, we credit an asset. So we're debiting supplies expense, we're crediting the asset supplies. So our entry is going to be December 31. We're debiting supplies expense, 7,700, and we're crediting the asset supplies. Be very careful because in the Wiley pull down menu, you know, you put SUP, it's just going to grab whatever one first. So make sure you're getting the right one. Okay. Any questions on the entry for that? No questions on the entry? Okay, so they will also want us to show what the T accounts look like for this. So the T accounts, we would have supplies. We're just showing these two accounts. Supplies expense, right? So in the beginning, we had 8,800 in supplies, and supplies is in assets. Assets have a debit balance, so we've got the 8,800 on the debit side. And over here on supplies expense, we had nothing. They told us we had nothing in that account. Then when we do the adjusting entry, we're going to debit supplies expense, 7,700, and we're going to credit supplies, 7,700. So that means that the balance in supply account is going to be 1,100, and the balance on the expense account is going to be 7,700. Okay. Oh yeah, the date. Oh, so you know, I'm glad you said that. So
Isn't 8,800 the first though? Wouldn't that be the first? December
no,
1?
it's December 31st. So this is what I'm going to bring up here. This is important. So on the homework, you're gonna get a problem kind of similar to this. And they're gonna want the starting balance, okay? So remember the sequence we went through? First, we do the transaction. We have the source document. We figure out the transaction. Second, we do the journal entry. Third, we do, or no, not this one, this is adjusting entry. Second, we do the journal entries, right? Third, we post them to the T accounts. Fourth, we balance the T accounts. Fifth, we do the trial balance, right? Sixth, we do the adjusting entries. So when we're doing this entry, over here, your starting T account number is the balance that you had in the beginning of the month. Or not the beginning of the month, the end of the month, before the adjusting entries. So this is actually going to be balance December 31, and then you do your adjusting entry, and it's balance December 31. The adjusting entry is happening on the same day, on the last day of the month. So in your homework, watch this. Your beginning balance number is the end of the month, because you've already went through the whole sequence. You've already done everything. You've balanced your T accounts, and you've done your journal entries. Now, in reality, it wouldn't quite look like that. In the real world, it would kind of look like this, and you would have supplies, and then you might have like entry, 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 and then you would have your balance here, December 31, right? This would be your December 31 here. 8,800, sorry. And then you would have your adjusting entry here of 7,700. And then you would have your final adjusted balance here, okay? We're just not seeing all the other transactions that happened in that account. We're just starting from right here. Balance December 31, okay? So this is not December 1. This date here. December 1 was up here. And then we had different things that happened. Maybe we bought more supplies, bought more supplies, bought more supplies. And then they're telling us here we started with 8,800. That's not the start of the month. That's what the T count started with at the end of the month. And then what you actually have. Does that make sense?
Mhm.
Okay. So make sure you remember that about the starting balance number. Okay, so that's 4.4. 4.5 says, at the end of the first year, the trial balance of Rayburn Company shows equipment expense, or shows equipment $22,000 and zero balances in accumulated depreciation equipment and depreciation expense. Depreciation for the year is estimated to be $2,750. Prepare the annual adjusted entry for depreciation at December 31. Post the adjustments to T accounts and indicate the balance sheet presentation of the equipment at December 31. Would we wait till the end of the year to do our depreciation expense for equipment?
No.
No. In the real world, you would not wait. In here, we're going to wait. We're going to do it. We're waiting. Not right, but we're doing it. Because it's not really about, what we're really trying to teach you is how to do it done. Is that bad? Not the correct way how to do it? We wouldn't wait because every month there would be an expense associated with it, which if we use that equipment to make revenue, then the expense has to be there every month, right? Okay, so in this one they told us the depreciation expense, how much it was, right? 2,750. We don't have to do any dividing or anything. So December 31, the adjusting entry. What are the two accounts that go together?
Equipment and equipment depreciation. Accumulated depreciation.
Depreciation, expense, and accumulated depreciation. So the equipment account, we never touch the equipment asset account. The only time that account is touched is when we get the asset and when we dispose of the asset. Okay, that account stays the same. So we have depreciation expense, 2,750, and accumulated depreciation equipment, 2,750. Okay. And they want to know the T accounts. So we've got depreciation expense, 2,750. Accumulated depreciation, 2750. And then they want to know what the financial statement looks like, just that line item. So we would have equipment. And we paid 22,000. And then we would have less accumulated depreciation equipment, 2750. And that would mean the book value was 19,250 for that equipment, for that asset. I'm going to show this real quick too. So that's the previous one. This is this one. Okay. All right, any questions on that one? Yes.
How did you do the, you know how the line that they pay, which is 22,000? Yeah, you subtract that, you just off the top, you don't have to.
Yeah, 22,000 is what you originally paid for it, and then you put less accumulated depreciation, and you subtract however much is in the T account for accumulated depreciation. 2750.
Okay.
So only 1 year's been depreciated so far.
So what do we do with that number right there?
That's just the balance. It's just pushed over.
Okay.
Yeah.
So would that be on the,
This is on the balance sheet. This line
Okay.
would be on the balance sheet. Yeah. So if you go back and look at the balance sheets from chapter 1, probably chapter 2, I think, you'll actually see these on there now. And now you'll know, like, oh, where's that coming from? Okay. All right. To the next one. All right, the next one is 4.6. And that one says, on July 1, 2017, Ling Company pays $12,400 to Marsh Insurance for a 2-year insurance contract. Both companies have fiscal years ending December 31. For Ling Company, journalize and post the entry on July 1 and the annual adjusting entry on December 31. So they want us to do both entries. So, who are we in this problem? We are Ling Company. So we're Ling Company. So we're the company that's buying the insurance. All right. So we bought insurance for a full year, right? For 2 years. Okay. So we have to take what we paid for the insurance, $12,400, right? Now, you are going to be inclined to want to take $12,400 and divide it by 24, right? Because there's 24 months in a year. I mean, 12 months in a year, and there's 2 years. Okay, so do not do that, because you will not always get the right answer. Depending on your number, if there's an odd number in there, it can mess up and you won't get the right answer. So the way you do this is you do 12,400 times something over 24. 24 represents the number of months this is good for. This is good for 24 months. Now you have to figure out the top number, the denominator, or the numerator, right? So you have to go back to the problem, and you have to figure out how much insurance have I used from the time I purchased it to the date I'm doing the adjusting entry. So the date you're doing the adjusting entry is December 31, right?
Yeah.
That's the adjusting entry date. When did you buy the insurance?
July.
You bought the insurance on July 1. So is this 12 over 24
No,
for a full year? Did you use it a full year's worth?
no.
No. So what you have to do, you go from July 1 to December 31. So the way you count it is because it's July 1, all of July, all of August, all of September, all of October, all of November, all of December. 6 months. So you've used up 6 months worth of this insurance. So if you took this, divided it by 24, and then multiplied it by 6, with this number, you would get it right because it's a whole number. I mean, there's no odd number, right? But you're not always going to get it right with your odd numbers. So what you do is you go 6 over 24, and then you turn that into a fraction. So this becomes 0.25, okay? Then you do 2,400 times 0.25, and that tells us that for 6 months, $3,100 worth of insurance was used up. Does that make sense? So watch your dates really closely. It's not always going to be a clean year.
So what becomes 25?
What was that?
What part becomes 25?
0.25?
Oh.
624 becomes 0.25. 65 by 24. Yeah. Okay, so $3,100 is 6 months of insurance that you've used up. So on December, so first they want us to do the entry when we bought it. So when we bought it, on July 1, when we bought the insurance policy, we debited prepaid insurance for $12,400. And we credited cash because we paid for it. So that was on July 1. And on December 31, we're going to do our adjusting entry for $3,100. Okay? So we're going to debit insurance expense for $3,100, which is 6 months worth of insurance. And we're going to credit prepaid insurance for $3,100. So this is our adjusting entry for December 31. Okay. And then on the T accounts, how it would look, that's prepaid insurance. This is insurance expense. At the beginning of the period, insurance expense was 0, and prepaid insurance was $12,400, and then we would do the adjusting entry. We would debit insurance expense $3,100. We would credit prepaid insurance $3,100. So that would mean we have $9,300 of prepaid insurance left to use up. If we canceled our policy on January 1, we would get $9,300 back. There was no fees or anything. All right. Questions about that? Any questions?